I just want to start recording this because it was not recording. All right. Okay, we're here again. All right. So including that, there's a lot of aspects that you need to do in your forex markets or in your trade when you're executing the trade, when you are taking the trades, for you to actually implement the forex risk management. So it's not just about just one. It's not about how many trades you are actually opening at that time, and it's not just only how many what lot size are you actually implementing it on that trade. Is not only maybe how many positions are open are running, or how much leverage and weight did we put at take profit and our stop loss. So it's all of those stuff, combine it together, right, and put it in a trade, including the planning of your trades, including how you plan your trades. That's basically, we call it the risk management of Forex. You combine all aspects of protecting you, of protecting your funds to not actually, have a bigger loss. You might have a loss in a market. What matters is the loss has to be smaller than the gain. The profits has to be much more bigger than the loss, right? That's what pretty much that we want to talk about. So as it says, forex risk management strategies help to limit the negative impact related to any trade you may take. It helps to limit. Doesn't mean you're not gonna lose if you didn't analyze properly, but it limits you to not lose, to not have a bigger loss. It limits you to not blow your account at the same time. That's what most important we should take about. Is there any questions? I can hear like someone is talking. Oh, I forgot to mute the mic. All right. Don't forget, guys, let's mute the mic so that we can understand each other. If you have a question, you can type it on the chat box, or you can unmute your mic and shoot the question, immediately, so that, we can move a little bit faster, a little bit quicker, and we can finish a little bit earlier also. All right. So the importance of risk management in Forex. The risk management is very vital to become a successful trader, right? For you, in order to become a very successful trader when you're trading, you need to apply the risk management and earning money using the Forex market. So if you want to be the Forex market to be, one of the things that it will gives you money continuously, you earn through Forex, you need to practice the risk management over and over again. So you need to monitor your account. You need to identify the product that you want to trade. You need to evaluate that product that you want to trade, how much you can risk on your own, right? Then you need to treat that product in a manner that you know that you risk a certain percentage of your account. A risk are inherited in a Forex trading, and there are two possible outcomes. Each time you initiated a trade, either you will lose money or you will gain it, right? The challenge faced by every Forex trader is it is not just their lack of the skill that causes a Forex trader to lose money, but their lack of risk management strategies, right? It's not about how much you know Forex, how much you can analyze your Forex, but sometimes it's about how much you don't know how to analyze or how to apply your risk management strategy, right? That can affect you. As we all know that the Forex market is actually driven by the economic events, the global economic events that happen each and every single day in the world, right? Now, if anything happened in a market, anything happened economically, right now we can agree, those who are actually trading right now, you can see there's a lot of insanity in the market at the present time because of the war that is happening between Russia, Ukraine, US is involved, NATO as an organization, it's involved as well. Those are the economic, politics, global challenges or global events that actually happen that can drive the market that you and me, we trade. So the importance is to understand the risk management, to understand how much risk we actually, we should apply or we should be able to, to strategize when we are trading. The risk management is one such important area that Forex traders need to understand at all mediums time, at all time. So far, ladies and gentlemen, are we good? Any question? Are we moving smooth and nice? Am I fast, quick enough or not? Are we good? All right, looks like we all good.
Perfect. You're still on track, buddy.
Oh, perfecto. All right. Okay. So these are some of the tips that you can actually implement it when you are trading. These tips we're gonna be breaking down bit by bit so that we can understand everything. Tip number one that I can tell you when you are actually wanna serious. Remember, we said you can understand this thing if you wanna take the trading very serious. Not a person that you come, you trade the next month, you say that, no, I'm stop a little bit. I'm gonna trade again, whatever time that I'm gonna have. This is a job. A lot of people, they are getting paid through this job in a daily basis. If you wanna take it serious, you wanna, master these things in a way that, if you wanna, maybe some of the youngsters to apply a new job in the banking sector, you can show them how much you've been trading. You can show them your statement of the trading. Some people, they can get hired based on the statement of their trading. But now we need to understand this knowledge and practice it over and over again so that we can be perfect on it and start whether growing our account or, whatever we want to do in the Forex. So number one, educate yourself on the risk involving with the trading Forex. So we need to educate ourselves what type of risk can it be involved in a Forex market. Once we understand that, once we know the type of risk that we can face, we'll be able maybe to hide or to dodge those type of risks a little bit. Okay. Right. So how should you trade? That's the first question. You should educate yourself as much as possible if you are new to a trading. Are you new to a trading? Are you researching more? Are you realizing when you execute a trade that, hey, I shouldn't do this. I could have done this. I shouldn't do 1, 2, 3. I could have do 1, 2, 3, right? Most important, and analyzing what you are trading, understanding what the results of the trading that you took when you closed the trade. No matter how experienced you are with the Forex market, there is always a new lesson to be learned. So keep leading, keep educating yourself on everything Forex related, right? Utilizing a stop loss order. These are also most important when we are trading. When we are utilizing the stop loss order, we are actually identifying and saying that, okay, we just need to lose this certain percentage. We don't want to lose everything. In that way, you can be able to calculate between, the money that you are losing and the money that you are gaining. And if you put it on a scale, as much as the gain is more than the loss, then we're good. Then we 100% good, and moving forward, the account is growing bit by bit. Utilizing a stop loss order, as we said, it's a regular occurrence, but it ends, you want to make more money than your lost. So you want to make sure that your profits are more significant than your losses. A stop loss can protect you against significant losses, whether it has to be a bigger loss, but because of you apply a stop loss, it does, minimizing a little bit, and just to, make sure that you gain a little bit of more profits in your account. Stop losses, however, are not guaranteed. The market can behave elatatiously. at a time. Creating a price gaps, consequences, a stop loss order will not be executed at the permitted level, but instead will be activated when the price reaches the certain level next time. Slippage can occur again when you're putting these orders, and again it can occur when you are in a market. So we should understand when you put the order in our market that there's a certain things called slippage. It can happen that the price didn't fill the whole candlestick to reach your stop loss order so that it can trigger, and now you can be able to to be on a stop loss protection, right? It happened to me yesterday. I put a buy limit, I put a buy order on a USD JPY. The candlestick comes all the way and touches my buy order, but because of there was more volatility and the price didn't fill all the way to that, it didn't trigger. If it was someone, I could have been screaming to my broker to say, why it didn't trigger by the price reaches this point? Yes, it reached that point, but because of there was a higher volatility at that specific time, then it occurs the slippage. It slipped away from the order that you actually, execute. So when you are putting the stop loss orders, we should always know that it may happen to slip away out of the stop loss, and you're gonna say my stop loss didn't trigger it because of the slippage. There was a higher volatility, slipped away out of that. So that we should always put it in a mind that it does happen in a market. That's how the nature of the market. So far, so good, ladies and gentlemen. Can just put the sharp.
Yusuf.
Yes, sir.
Yes, Yusuf. Yeah, I heard you right now speaking about your volatility. Then
Yes.
I wanted to get the clarity on that. Once the market get into this volatility, what happens there?
Okay. All right. So maybe let's just break down what the volatility means, right? The volatility, it means the volatile of the market. The word volatile itself, it means a lot of things happening at the same time, right? So when you apply it in the Forex market, it actually tells us that the movement of the trade, that's the volatility. So when we say the market has a higher volatility, we actually mean that the market is moving fast. The candlesticks and the movement of the market is actually quicker and faster, right? That's why we call it the volatility of the market. When we say we have a lower volatility of the market, it means the market is not moving that fast, moving slowly. Bit by bit, it's growing, whether growing, gaining the points, or whether losing the points. So when we say it's depending on the volatility of the market, we mean that it depending on the fastest of the market at that particular time. So if you put your stop order to say that you open a price at 100, you put a stop order at 105, it's a sell. You said once it get to 105, it triggers your stop order, it stop you from that position, right? But now if there's be more quicker volatility, let's say it moves 10 pips per second, right? And come down again per second in just 2 seconds. That means there's a higher volatility. It might not trigger your stop order because of the whole data, it was not collected and full the whole candlestick. It only do fast, quick up and come down quicker. I don't know, did you get me?
Yes, no, I did. I thank you very much.
All right, it's clear enough, right?
Very clear.
All right, all right. Thanks a lot.
Thank you.
All right,
Thanks.
anyone else questions so far? Oh, we so far so good. All right, let's move on. 3, secure your profit with the take profit, right? We're talking about the stop loss. Now we have to secure it with our take profit. A take profit are almost identical to the stop losses, but as the name itself, I don't know, can you see guys here? Because it looks very, very small, these things. Maybe let me just try to increase it a little bit. Here we go. Yeah. All right. So, but as the name suggested, they have the opposite objective. When a stop loss is used on a trade, automatically closed to prevent further losses, while when the take profit is used, automatically close the trade to after a certain profit level has been reached, right? So don't take too much risk in the market. Forex traders should never take or more risk than they are willing to lose. This is a fundamental rule of the risk management. Unfortunately, it is a common for those new of the Forex trading to break these rules. Despite its fundamentality, most of the new traders, what they do, they open a lot of position. When they see this one, it's on a loss, they run to look for something else and open again, right? And you should always understand this thing, ladies and gentlemen, that each and every instrument that you are trading requires a different margin. So if Euro USD wants you 5 Rand, doesn't mean a GBP JPY it want 5 Rand again. Maybe it might want 4 Rand for you to execute that trade. If Nasdaq wants you 10 Rand to execute a Nasdaq, it doesn't mean US 30 it will want 10 Rand again. It might want 7 Rand to actually you to execute that trade for that position. So if you execute this trade for this pair, and now you jump, you look for, because it's on a loss, and you look another instrument, you think that, oh, this one is much more better. Let me execute that one. Let me take that trade. You know, you might increase now the margin required in your account. So you end up now quickly running on a margin call or a margin level loss or a margin percentage below the margin call quicker than if you could have go gradually. Choose your pairs perfectly and say that I'm trading these pairs at this particular time. I'm going to open a different pairs when you close this type of pairs, because in that way, your calculated margin required per each and every instrument that you want to trade, and you 100% enough to say that it will be able to hold my trades even if it goes against me, right? So ladies and gentlemen, let's take a note not to be all over in a market, but actually execute a trade that are calculated risk. So traders who put more at a risk, they can afford to put themselves at a risk. The Forex market are highly unpredictable, so traders risk putting their entire portfolio at risk. Taking on too much risk with each trade suggested that even a tiny sequence of a loss, it's enough to wipe out of most of your trade capital. So take a note of that, ladies and gentlemen, right? All right, all right. Don't forget, I do send the presentation if you want the presentation. And again, you know, the videos, I do record the video as what I'm recording now and send it on my YouTube channel. You can follow my YouTube channel. It's called The Daily Money Market. It's The Daily Money Market. It's on the YouTube. The most also article, I do send them on Instagram. If you guys, you're social media people, search The Daily Money Market, you find everything is there. So far so good. Should we move on? All right. So ladies and gentlemen, as usual, the Zoom thing, you know, the Zoom is gonna cut in actually in a couple of minutes, in 10 minutes, but I'm gonna remind you guys, when it cuts, if we didn't finish, let's join in again to finish up the last tab. That's what we always do. So here is a tried and a true to avoid a risk more than a 2% of your account balance per trade. The size of the open position is often adjusted in a response to volatility in the pair that they are trading. For example, the size of the open position is often smaller when trading volatility currencies, Your trading capital may be burned through if you suffer a terrible loss at some point. After significant loss, it is tempting to recover your investment in the next trade. However, when you are already low on your account balance, increase your risk. It's probably the worst decision you can make. So basically, this is what most of the new traders, beginners, they always do. They enter in a market, couple of trades, they are on a loss. When they close those trade on a loss, they want to jump in a market and actually execute a trade, and they want to, you know, recover. And that mind, it's a human thing. It's a human mind that we do have, all of us, to say that I want to recover quickly. You know, what I lost, I just lost money. I want to recover the money. The problem is, the more you lose, the margin already has been reduced. Your margin free percentage has been deducted, reduced from your account. So the second position that you're going to enter, you're going to need to think really very careful. If you just a little bit increase the volume, or over risk a little bit, or it just go opposite your direction a little bit, that's where you actually, you know, wipe the whole account. And again, you might trade in a time that there's volatility. When such thing happen, that you have a loss and you decided to close the trade, wait until the volatility to come down. Because when you want to recover during the same time of volatility, you might wipe your account out, all of it. So this is what we are avoiding to wipe the account, all of it. I do have the account that I'm running it. It's been a month right now. But if I can tell you the story, I started with a very small amount of money. You know, the aim on this one is just, you know, to understand that how long can I hold this account without blowing it? Can I trade every day with this account without losing my money? Although even I'm losing, but without blowing the account totally. There was a $10 on the account. Sometimes I grow it all the way to $70, $100, lose some money, continue coming back. But my point is, I've been having that account for over a month now. Some of you, if you had a $10 account, you blow it in a day, in a minute. Some will blow it in 10 minutes, in 30 minutes, right? The skill that I'm teaching here is how can we manage to hold that account. If we manage to hold that small account, although it's not growing rapidly, growing bit by bit, but we are holding it and continuously trading it, continuously pushing it all the way up. That's the most important skill that we actually wanna, you know, invent to everyone. Today, my problem of blowing is over. Thank you very much. Don't say that, sir. The next week you blow again and say that, hey, I blow. But if we are, Mr. Andrew, if we are practicing this risk management, you know, over and over and over it again, we will actually realize on our own that, you know what, we can trade. Just that we don't pay much more attention for what we are doing. You know, sometimes we driven by emotions of the results of the market, and we want to come, you know, roughly in a market, right? As I said earlier, the whole global market, it's driven, the whole Forex is driven by the global economic events, political events, pandemic events. Anything can happen anytime. No one knows what is going to happen next month in certain country in this world. No one knows what economy of whatever country in this world, what will happen by next week or next month, right? That we should always keep it on our mind. That is why the risk management tools are very important when we are actually, you know, applying it. Any questions so far? So far, so good. Any question? All right. Looks like so far, so good. Thank you. We're jumping to another tab. We still have 4 more minutes. Then it's gonna cut. And then please rejoin again on the platform. All right, the use of leverage, Springly. The use of leverage, ladies and gentlemen, this is also one of the tricky part. Oh, of course, I forgot to mention something here. However, when you're already low, okay, I've mentioned this. All right. All right, the use of leverage. All right, is there anyone who understands what leverage is? This is very, very big questions to most of the traders. Some traders, they've been trading it, they know, they understand, but they don't really understand how it works. So conversation, ladies and gentlemen, anyone knows what leverage is and how it works?
Yeah, we are in the dark on that one, but we are in the dark. Can you explain to us?
You're in the dark. You shouldn't be in the dark. You know, you should be able to to answer this thing, but it's fine. Each and everyone, if you guys remember, you actually choose the leverage when you are actually opening an account. You choose a certain leverage when you're opening an account, if you guys remember. So the leverage that we have here at Globex 360 start from 1 to 100, 1 to 200, 1 to 300 as a maximum leverage that we offer. Right. So the use of a leverage can increase a profit potential, but it can also increase the loss potential. Increasing of the risk, for instance, with a leverage of 1 to 30, you can place a trade worth of $30,000 on an account, worth of $1,000. So it means if you put $1,000 and you actually take 1 to 30, you can actually have placing the trades worth of $30,000, right? Doesn't mean you're gonna place the whole trades at once, but that's what the whole account gives you. It gives you the equivalent of $30,000 for you to actually trade with that. So same applies when you put 100 Rand, multiply by 1 to 30, it gives you 3,000 that you can be able to place the trades in your account, right? I hope there you are understanding me when it comes that, and you are therefore exposed to more Forex risk when you have a higher leverage. To limit your exposure to a Forex risk management, it is advisable to avoid the higher leverage if you are a beginner. Utilize the leverage only when you understand the potential losses, right? By following this advice, you will avoid a significant losses to your portfolio. You will also avoid the being on the wrong side of the market. It is not difficult to understand how Forex risk management works. However, a tricky aspect of a risk management is self-discipline when the market moves against your position. All right. So in short, yes, question? Is there a question? Oh, it's Christina. Welcome, Christina, for joining us. All right. So what we are trying to say